This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. It is not intended to cause or induce breach of an existing agency agreement.
Hello? 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 This is the Vancouver
Commercial
Real Estate Podcast.
And welcome back to the Vancouver Commercial Real Estate Podcast. I'm Cory Wright.
And I'm Melisa Moretti.
And Melisa, on the show today, we have, which is, as Matt would always say, is a fan favorite.
Past guest fan
favorite, Jon Switzer of Impact Commercial Group. Why we wanted to have him on is I had received a bunch of emails after the interest rate hike took place last week. And whenever it comes to interest rates or financing, Impact Commercial is our go-to. So our guest this week was very gracious to allow us to move him back a week, and we had to jockey a couple other people. But we wanted to get Jon on right away to find out interest rate hikes. Is there more hikes? What is going on? So Jon was very gracious to take his time today to join us there. Before we get to that, you were telling me about I've never heard about a more exciting opportunity in my life than a bachelorette party in downtown Winnipeg with no beer. So can you maybe elaborate a little bit on your past weekend there? Because I know Adam and Matt are from Winnipeg, so we can't say too negative things about it. But yeah. So tell how was the bachelorette party in Winnipeg, home of the Mosquitoes, in June with no beer? How did that go?
Yeah. Well, first of all, obviously Winnipeg is not the top choice of brides for their bachelorette weekends, but my friend had family there, so we went and spent some time with them and did a few things, but none of us are big drinkers, and so we had a pretty PG weekend. But overall, there's a couple good things. They've got a really nice spa. We did a spin class. I would say, if I wasn't with my friends doing the best things Winnipeg has to offer, my rating of the city may be about a 3, but I gave it a 6.5.
6.5. So it's clearly to say this is on your next vacation list then.
Well, I've already been there. So,
so you're not going back anytime soon.
I have to say though, I do see why Adam and Matt have come to Vancouver. It really makes you appreciate. It really nails it down. Usually you go away and you feel like, oh, you come back, you love Vancouver. Yeah. This time I was like, I really felt it in my soul.
So when you came back over here, you're like, I don't mind paying $5,000 for rent. I don't mind paying $4 million for a house. Just get me out of Winnipeg, get me into BC.
Yeah, pretty much.
Awesome. So without further ado, let's get to our interview today because it does run a little bit long there, and I know there's a lot to unpack in it. Enjoy, guys. Jon Switzer, managing partner, Impact Commercial Group, breaking down interest rate increases and what is happening.
All right, let's go.
This week's episode is brought to you by our great friends at Impact Commercial Group.
Really enjoy working with Impact Commercial. And we should say Al and his team can basically do anything when it comes to lending.
Anything when it comes to under the commercial umbrella. You're building a building and development, we got you covered. You're buying land, we'll make that happen for you. You're investing in a property or multifamily building, check. Owner-occupiers looking to acquire their own space, double check. Anything commercial financing you need, Impact Commercial is your go-to.
ImpactCommercial.ca. And we should say, over 50 years of combined experience. So trust these guys. They're the right fit.
Best in the business, in my opinion. So we're here today with Jon Switzer, managing partner, Impact Commercial Group. Jon, how are you doing today?
Doing just fine, guys, despite rather volatile environment here.
Well, Jon, you need no introduction. You've been on so many times, and obviously why we want to have you back on is as the podcast for the people, we like to say. I was inundated with emails over the past couple of weeks asking about interest rates, what's happening, all this stuff. So we had to quickly stop everything, call Jon and Al at Impact Commercial, move some guests around to get them on today so we can find out what is going on out there with interest rates. So, John, before we kind of get to that, because like I said, you do need no introduction, but there might be a couple listeners out there that haven't heard your previous episodes. Can you tell us a little bit about yourself?
Sure thing. Yeah. So prior to getting into the commercial mortgage business, I was on the finance side. So dealt with municipalities and some larger institutions on cash management. So we did some bond trading and things like that. More exciting than it probably sounds. I actually made it through some of the very challenging times in the financial sector from when I started in March 2008, the day before the Bear Stearns crash.
Oh, good timing. Good timing.
Great time for a new career in finance, but no, it was an amazing learning experience. After a pretty good stint there, I brought a lot of those tools over to Impact Commercial back in 2017. And it's just been a wild ride and tons of fun. Loving being here every day and trying to just keep on top of all these very wild, quick changes going on in the market these days. So,
well, as I said at the top of the show here, that's exactly why we wanted to have you on. Last week, the Bank of Canada raised the overnight posted rate by 0.25% or 25 basis points. If we look at kind of the start of this year, the sentiment kind of the takeaway probably was there was a plateau in rates earlier this year, and we kind of thought that's how the year was going to kind of finish out. There was some stuff happening down south with some of the banks down there that was causing some impact in the states there in the banking sector.
Sure.
Fast forward to June, interest rates have moved up 25 basis points. What is going on?
Yeah, and I mean, I would actually say, I can't remember if exactly it was the end of last year, beginning of this year, there was actually started to be talk of potentially an earlier rate cut in the middle sort of this year, especially in the U.S. They were talking about that. Originally, we were thinking, we meaning the economists that I follow closely, it was kind of starting to be consensus that there might be the first cut at the Bank of Canada that towards the end of this year, and then all of a sudden we're back on talking about rate hikes. So yeah, it was a major 180, in the messaging from the Bank of Canada, and then it was a surprise right up until the day of the hike because most of the sort of talking heads were talking about potentially a July hike and more kind of confidence growing that they might hike in July, and then they seemed to kind of jump the gun and hike in June. So it surprised the bond market. I heard that it actually made some waves across the global bond markets just because it was that much of a surprise. So that's where we are, and then now it's sort of you've got a lot of the big five bank economists. Or there's not that many big five banks, but you've got at least a couple of the guys saying that they pretty much expect another hike in July, although it's always, a data dependent thing. And I think that's important. Like there are head games going on with central bankers. Like they're playing head games with the population a little bit. It's how they can kind of keep things in check, right? So we have to be a little careful following the language too closely. They're always leaving themselves lots of leeway. And most importantly, like I think along with a lot of people smarter than me, that they are purposely overshooting here. So they're taking a bit of a bazooka to inflation, even though it doesn't feel like it with a quarter rate hike. It seems kind of minor, but a lot of people, don't think they needed to do that at all. So, I really do think they're overshooting to make sure that they get a handle on inflation. And that's largely because I also believe they waited way too long with rates way too low during and after the pandemic. So it's a reputational thing now, right? I think they'd rather almost mislead the market into like, yeah, we're not afraid to keep raising and raising and raising until inflation is dead. But I think they'd rather go back on that word than go down in history as, dropping the ball on reining in inflation. So
there's lots we can unpack there. First off, another 25 basis point rate increase. Why and when?
Okay, again, I'm not an economist. Always should have thrown that one out there at the beginning. But
No. We hold you to everything.
I wouldn't be. Nothing would surprise us now, right? Like I think we can all kind of say that. I think if they raise another 25 in July, not going to be a surprise at all. Although if you told me that, or pretty much anyone that 2 or 3 months ago, it certainly would have been a surprising sentiment. But that's where we are now. That the bank, again, I just think they're trying to spook the market into submission. We still got persistent strength in employment. We saw the CPI come down quite a bit in the U.S. from 490 to 400 basis points, but the core inflation is still very strong. So that's excluding food and energy, is being very, very stubborn. So that's what they're watching. But, we also there's a lot of data coming in that's looking like the brakes are starting to be applied here in the economy. So I'm sure a lot of the listeners saw that we had a 20-year low in Q1 new mortgage origination, on the residential side. So actually, that may even include commercial, but residential is a much bigger basket. So that's a big one, and obviously a lot less money sloshing around. And along with that news came also news of lowering decreasing disposable income. So those things are going to start to have a meaningful impact. And when inflation does start to grow a lot slower, which is really what we're hoping for here, it's not inflation actually going into the negative. It's just that growth needs to slow in inflation from current 4% range down to that 2 to 3% range. So when that does start to happen, it can happen pretty quickly, and we could see this Bank of Canada sentiment change very, very quickly, just like it has surprised us to the hawkish side, as they say, when they are raising rates or tightening. It can happen the opposite to the dovish side very, very quickly. So that's what I think is going on now. Just they're overshooting. They haven't even given enough time for these this crazy pace and magnitude of rate hikes to actually work into the economy. All the economists say it. Depends who you listen to, but they say kind of 8 to 14 months, whatever the case. It takes a long time for any central bank policy around the world to actually work its way through the economy. So that means that if you look at, let's take a 12-year example, the rate hikes that happened last March would have only been kicking in this March. So for them to still be raising now without really understanding the longer-term effects of this policy in the last kind of 14, 15 months, it's really interesting. I just think they're taking a massive club to inflation here, and with the goal of overshooting.
And how much does our neighbors to the south impact our interest rates up here? If they tend to slide down there, do we kind of mirror that? Not saying that we want the American economy to fall apart, but it definitely seems they're probably in a more challenging position than we are right now. If that continues to go down that road, do we mirror what they do, or can we stand alone on ourselves and not have our dollar get destroyed if they drop and we hold?
Well, there's the old adage that when the U.S. catches a cold, Canada catches pneumonia, right? So that is something. But I actually would push back a little bit that the U.S. is in more trouble. Like, one of the things down there is the average American feels an interest rate hike way less than Canadians because of their 30-year mortgage terms. So if you walk down the street and ask anybody, you see when's their next mortgage renewal, you're going to get answers from, the odd person might say in the next 2 to 3 years, but you're going to have people saying, 17 years, 22 years, right? Like, these effects are not felt the same way in the US. So they have the ability to raise more than Canada without, and basically have the same effect with a larger raise down there than a small raise up here. So because we are so real estate dependent, and we have a lot less economic diversification in Canada, like we just feel all of these actions a lot more in our day-to-day lives than Americans. So, but to that point, the FOMC held rates. They really hinted at raising in July, but again, it's this kind of tug of war with their reputation. Like most people think that Jerome Powell has dropped the ball by leaving rates again, way too low for way too long. So most people, again, smarter than me, think that he's overshooting as well, right? So, and everybody's always going to be watching the U.S. for guidance.
Now, obviously, the bond market dictates what we do. The overnight posted rate dictates what we do. For the listeners that haven't caught your previous episodes, can you maybe just recap what the bond market impacts and what the overnight posted rate rate impacts, variable versus fixed?
Yeah. So, I mean, in simplest terms, the overnight rate pretty much directly drives the bank prime rate. We call it the bank prime rate, but all the banks pretty much carry the same prime rate. So the spread over the Bank of Canada overnight rate is 2.2%. That's been fixed for a long time. So when you hear, the Bank of Canada has raised rates since last March from 0.25% to 4.75%. Now that means that the prime rate is at 6.95 because you're adding 2.2%. So then you have the spread over or under prime, depending what you're doing. In residential, there's often a discount to prime, as most of us probably know. In commercial, there's usually a spread above prime. So I would say the average kind of commercial spread on a variable mortgage is 1% over prime, but there can be, a big fluctuation there. You can have construction loans at 2 to 2.5% over prime and then way up. And you can have really strong borrowers at basically borrowing at prime in commercial. So huge range there, very dependent on underwriting, the borrower and the property. So then on the fixed rate side, you're always pretty much measuring a spread over the Government of Canada bond yield. And that is specific to any term you're looking at. So if you're looking at a 2-year mortgage term, then you're going to be looking at the spread over the 2-year bond yield. Mostly, in Canada, we're looking at the 5-year bond yield over the long run. That's definitely the sort of the benchmark term is 5 years. So in that, we have seen lender spreads go up. Back in March, we were looking at a spread of just over kind of 2% with our lowest cost lenders. And just this week, we got some quotes that were 2.35% over prime. So we're looking at same lender, but now we have much higher bond yields and a higher spread. So you're not only getting hit by, action in the bond market, you're also getting hit by the lenders pricing in an additional premium. So you just have this compounding pressure on borrowers, right?
So the pink elephant, the big pink elephant in the room here is kind of where do rates go over the next 12 months? And I guess the bigger question is, when do they come down? Like, where do you obviously, is there indicators that we need to watch for that potentially will give us the indication that fast forward a quarter after that happens, they start to come down? Is there consensus 2024 we're coming down? Where are we in 6 months to a year from now with these rates?
Yeah, obviously super hard to say, but I'm happy to just give my sort of opinion based on, feel and being through a few economic cycles in a couple of different roles. Obviously, you're always going to be watching GDP. You're going to be watching core inflation more so than the CPI, because core strips out, arguably the most volatile items of food and energy, and you're looking at employment. So those have all been, stubbornly high. Although GDP is showing some signs of cracking, which is actually, sort of counterintuitive, but that's what we're all kind of hoping for. We don't necessarily want to see a deep recession because that causes a lot of pain, but we definitely want to see some economic weakness because we need obviously these central banks to have enough information to be able, enough data to be able to say, okay, I think we're actually done now. And then when that happens, we should start to see. First thing that should happen is bond yields should start to come down very quickly. We've overlaid the bond yield with the Bank of Canada overnight rate over the course of time, and we've seen that almost always the bond market accurately predicts where the Bank of Canada is going. So it's been very touch and go the last kind of year, but over longer term, that's what you'll see. So that's the first thing I'd watch for is some of those economic indicators leading to a rally in the bond market, or inverse of that is yields coming down very quickly in the bond market, and then I would expect that we'll start gearing up for the first rate hike. Some of the kind of pundits in the U.S. are talking about, I believe, middle of 2024 is where they're expecting it. But keep in mind, everybody's been so wrong on all of their predictions. Like the most aggressive Big Five bank economists, and I won't name any names, but the most aggressive of the group was calling for, I think, 270, like 2.75% as the top of the interest rate cycle. So, they were, and then you had guys down at saying it was going to max out at 2%. Well, now we're at 4.75% and probably going to 5%. And these are arguably the strongest guys, or the smartest guys in the room, right? So it's really, really tough to say, but my gut keeps coming back to just believing that the central banks got it so wrong, leading us out of the pandemic, and arguably they never even should have cut as much as they did. So they overshot by a mile to the downside. They're going to overshoot probably at least as much to the upside just to make sure they get control of this, right? And when that happens, I think it'll be done for a while. Like we'll be into the next economic cycle.
No, let's just say hypothetically rates don't come off when we're all hoping. Is there a doomsday scenario where there's probably a lot of fixed mortgages, whether that be late 2024, early 2025, or whenever that time is, that are coming up for renewal, probably both on the residential and the commercial side, that there's kind of a doomsday that if rates don't come off by this time period, this is when we're going to see a lot of people coming out of their 3.5 fixed mortgage from 2018 or 2020, and they're going to get whapped, and then that's going to create even bigger issues. Is there sort of a scenario like that people are watching for, or hopefully trying to avoid?
I mean, honestly, Cory, it depends who you talk to, because you can talk to some people today that are living that out right now, and the Bank of Canada has its own projections that people are going to be renewing with mortgage payments 40% higher this year. Not everybody, but there are enough situations where the Bank of Canada is actually putting it in their literature that some people will have a 40% increase to their mortgage payments. We've also heard some scenarios recently, like very recently, last couple of weeks, where the banks are all of a sudden just jacking up the spread on lines of credit. So don't quote me, but I think it was like someone that one of the Big Five banks had a line of credit at prime plus 2.5, and all of a sudden they got a letter saying they're at prime plus 6.5 or something like that. So it's kind of like, if you're in a good position, you can weather the storm, and you're probably never going to feel that like it's doomsday. But some people are there right now, and the bank's not stupid. They're watching what's happening in households in Canada and the US, and they know they can't keep raising. Like they cannot keep raising indefinitely. So, and then the other thing to think about is the longest kind of period that we see the central bank interest rates plateau before they start cutting is kind of 2 years, and that's a bit of an outlier. It's usually, I think, thinking back to some of the charts we looked at, it's more like 6 to 8 months to a year and a half is kind of the sweet spot for how long rates stay elevated. So I have to think that we're not far off from the top, and pretty much everybody still believes that. But again, everybody's been very, very wrong. So take it with a grain of salt.
So you're on the commercial mortgage end of this whole thing. Have you guys seen on the lender side? Have you seen deals tail off that are coming in, or is there certain asset classes and or areas that are still strong or become stronger with higher interest rates?
Stronger with higher interest rates? Probably not. I mean, there's still strength out there, and it's very property dependent, right? And it also obviously is very asset class dependent. So in the multifamily class, you have the option to go with CMHC, and you're still seeing rates over there in kind of the mid fours with longer amortization and longer terms available. So you can still make the numbers work in multifamily, and obviously there's a much bigger conversation there around we're bringing 1 million people into Canada a year, and we're not really building any housing. So it's arguable that rents are going to go through the roof. I don't need to belabor that one too much because you've had guests on that are much more entrenched in that than I am, who have spoken at length about it. But so multifamily, I think all the lenders still want to lend on it. There's tons of good product out there that still makes sense. Industrial, anytime you have kind of a market with global low around 1% vacancy rates, and most of the brokers around town will tell you that it's more like a structural 0% vacancy. It's just that there's movement around the market. You're always going to have strength there. People need it. So what you're seeing there is price growth, or at least stability in industrial, isn't being led by investors. It's being led by owner users, and you actually even see it in the appraisals. You have the income approach is always appraised lower than the direct comparison approach because owner users don't care about the fundamentals of the investment. They just need that to continue to operate their business, right? So yeah, same old story, beds and sheds with multifamily and industrial, very strong, lots of money to lend on those. Open air retail, that especially, we call it covered land play with redevelopment potential down the road, but strong holding income in the meantime. Those are, everybody wants to lend on those because everybody understands it. You're able to debt service the mortgage for as long as you want with the current use, and down the road, you're most likely going to have a huge lift, either developing it yourself or getting it ready for development and flipping it to the final developer. So yeah, I mean, to answer your question, there's still lots of liquidity out there amongst the big lenders. There are situations where there's not as much liquidity amongst some of the sort of alternative B lenders, but that's more of a case by case sort of individual circumstances. So yeah, lots of money out there for the right asset and the right borrower.
Well, Jon, we appreciate you jockeying your schedule to come join us on such short notice here to kind of give us an update of what's going on. But before we let you go, we do have our 6-pack lighthearted questions. Now, we've had to completely rework these on the fly because you've done them so often. So if you've got just a couple more minutes to hang out with us, it would be great.
Yeah, absolutely.
The 6-pack is powered by our great friends over at Red Point Law.
Oh, the guys at Red Point Law are fantastic, Cory.
For all your legal needs when it comes to commercial real estate, visit them at redpointlaw.ca. First question up, a quote that inspires you or a quote that you live by?
I mean, we all hear this all the time, but I really do try to live by it. Perfection is the enemy of greatness, right? So I have struggled with being a perfectionist in the past, and it rarely gets you, ahead faster. So definitely try to live by that one.
All right, next question. What's one book you recommend our listeners read?
Okay, that's an easy one right now with interest rates, going up at a record pace. I'm reading Art of War, revisiting that one.
Good choice. Good. I thought after perfection is the enemy of greatness, I thought you were going to say Good to Great by Jim Collins, because he quotes that great or good is the enemy of great.
Yeah, and that's a good book for sure too.
All right, next question up. Post-pandemic, are you wearing a suit and tie to the office or a sweater and a golf shirt?
Right now I'm wearing a golf shirt. I don't remember the last time I wore a tie. Suits are pretty infrequent, but that was also the case prior to the pandemic. So we're just kind of, we'll call it business casual here at Impact Commercial.
Business casual, Lulu's on Fridays.
Potentially.
All right, next question. You have unlimited funds. Interest rates don't matter. What's your dream car?
Oh boy, I'm a big car guy, so that is a bit of a head spinner.
Oh, this is a good question then.
Yeah,
Melissa thought of this one.
There's it's a crazy one, but since you asked, there's one called the Aston Martin Valkyrie. I'd recommend Googling that for any car nuts out there. They probably already know what it is, but it's just a nutty.
It's funny. It's funny you say that. I think Adam at the podcast has one of those.
Oh, I'm sure he does. He's got,
he owns property in Kelowna. I'm sure he has one. So for our listeners and for me, how much would this Aston Martin run me? Or your car, not mine. How much would you be paying for it?
The market value, I have no idea. I highly doubt you can buy one. There's probably, they're probably all gone. But if you bought it in the private market, I'd have to guess $4 or $5 million.
$4 or $5 million for it. No, this is one of those appreciating cars, not depreciating cars, I'm guessing.
I'm guessing too, yeah. Especially with 4% inflation, right?
Something you've purchased that's had a positive impact on your life for $1,500 or less.
So let's stick with the car theme. I'm working on an older BMW, so just some parts for that, which is always get a ton of pleasure out of that.
And when you say older BMW, can you elaborate on what this old BMW is?
It's not super old, but it's a 2008 wagon. So I'm into I'm the family guy that also is a car guy. So the wagon is a nice, performance wagon is a nice in between for me.
There you go, minivan, SUV, but instead we got a wagon.
Yeah, well, my wife's got the SUV, and I've got the compromise.
There you go. There you go.
All right, next question. Favorite sport or sports team?
I have to go with the Canucks, as painful as it's always been. I certainly can't go with the Seahawks anymore on the NFL side. So yeah, we'll stick with the Canucks and just hope for the best.
So John, we have a bonus question here today.
Okay.
On a scale of 1 to 10, how good of a golfer am I? And I'm asking John this because John, this past weekend, we had our William Wright Whistler retreat, and John was in my golf group. So me and John played together for the 18 holes up there at the Whistler Golf and Country Club. And then John, how good is my golf game on a scale of 1 to 10, 10 being Tiger Woods, 1 being probably better than I am? On a scale of 1 to 10, how would you grade my golf game?
In all honesty, I'm not a good resource for this because I was so focused on not losing my 14th ball. I just was laser focused on my own game. But I'd say you're around where I'm at, which then I'm not insulting you too bad. I'd say like in the mid range.
The mid-range. Yeah. Well, that's more than I thought. I was going to give myself probably a negative 2.5.
No.
Because I was probably, and this probably talks about how John plays golf. How I measure my golf game. If I come off the course and I tell you I'm -6, that means I've lost 6 balls.
Yeah.
If I come off the course and I'm +12, I found 12 more balls than I started with. So that's a good score.
I love that philosophy.
How I keep that's how it is. But if I come up +10, I've hit my ball in the fescue quite a bit because obviously I've been looking for my ball in the bush and I've clearly found other ones.
Yeah,
so,
and the deeper you hit it into the fescue, the more balls you find. So I'm gonna steal that one for sure.
And here's the way I look at it, right? Like I'm paying the same price as everybody else. If I play with a really good guy and he only gets 64 shots, and he paid the same price as me and I got 120 shots, I got better value for my dollar. I got double the shots this guy did.
Very sound logic.
So that's the way we play. That's the way we play golf here at the William Wright Whistler Retreat. We do it every year.
Yeah.
Jon, for all of our listeners there, I want to find out more about what you're doing over at Impact Commercial and interest rates and all of that stuff. How can they get a hold of you?
No, thanks. I would say just look on our website. We got a bunch of great brokers now. I think there's 7 total of us now with some support staff. So lots of experience amongst the whole group. So figure out who you think you're going to kind of jive with, and everyone's contact information is there. You can access us all on LinkedIn is probably the best social media resource as well. So we'd love to hear from anybody we can help.
Well, Jon, thank you so much for taking your time out of your busy schedule to join us here. Give us a breakdown of what's yet to come in the side of the financial markets and the interest rates. Anytime,
guys, as best I can, but always happy to try to weigh in.
Great. Thanks so much, Jon. Take care.
Thanks, Jon.
Right, take care.
Take care. Bye-bye. There you have it, folks. Our interview today with Jon Switzer, Managing Partner, Impact Commercial. I'm really glad we had him on because there was some stuff there that I didn't foresee or anticipate, that he kind of unpacked a lot there for us, that there might be potentially another rate hike. Maybe in 2024, we're starting to come back off. At this point, I think his conclusion, as is most economists, the Bank of Canada, everyone that's tried to predict interest rates has been wrong.
Yeah.
So even now, reading into what they're saying, they could be wrong again, and we could be having a show in 6 months from now where maybe we're 25 basis points below where we're at today. Yeah. Fingers crossed. Time will tell. Always great having Jon on it. Well, so on the residential side, obviously interest rates have gone up. Do you foresee that having an impact on the housing side, or are we still, inventory levels still so low that people are still buying?
I would say the only thing that's going to have a big impact on things is if inventory starts to come out. A lot of inventory, right?
Do you foresee that? Is there grumblings about that, or is it kind of like, hey?
I don't necessarily think so. No, because the thing is, where are people going, right?
Yeah, good point.
That's kind of, the story, right? But right now it's still very competitive. I've got buyers who are in multiple offers. Things are going subject free. Not every property, but you're seeing it, right?
Yeah.
Where we weren't seeing it in, September, October, right? So
supply and demand.
Yeah.
It's been the same problem here for decades. It'll be the same problem for decades
Let's
after.
just say it's not Winnipeg.
It's not Winnipeg.
We don't have the same sprawl.
Yeah, that's true. And with all due respect to any listeners that join us from Winnipeg, there might be one or two, maybe.
Yeah.
Well, Adam and Matt are from there. There could be more listeners from Winnipeg than we know.
Their dad, Jim.
Yeah.
Shout out to Jim.
Yeah, to Jim. Apparently, and I haven't fortunately I've not met Jim yet, but I always hear from Adam that when his dad rates the show good or bad, that's what dictates
absolutely
what the next shows sound like.
Yeah.
Right. So, Jim, if you are listening, I haven't had the pleasure of meeting you yet, but if you could highly, highly rate this show and tell Adam how great of a job we are doing, we would appreciate that, because I'm sure, as in most businesses, if the economy slows, there's going to be cutbacks, and me and Melissa might be looking for a new job. So, Jim, if you could let Adam know just how good we're doing, would be greatly appreciated. And for all those who do still want to buy and sell real estate, they can reach me on the commercial side at 604-428-5255 at our Vancouver office. Let us know what you're looking for. We'll put you in touch with the best broker within the province. You can send me an email, Cory@williamwright.ca, or visit our website, williamwright.ca, and sign up for the latest and greatest news. And for all of those people who want to go buy real estate on the residential side in multiple offers, subject free, Melissa, how can they get a hold of you?
You can call me at 778-869-4477 or email me at melissa@vancouverrealestatepodcast.com.
Well,
also, guys, if you want to sell.
If you want to sell.
It's a good time.
We're looking for sellers.
Yeah.
We're looking
for sellers.
We're looking for sellers right now. So sellers, if you're out there and you want to sell your house, get a hold of Melissa. She's going to sell it unconditionally, over asking, multiple offers, guaranteed, or she buys it from you.
Hey, there you go.
There you go. There you go. Thanks so much for listening, guys. We'll be back next week with another exciting guest.
All right.
Subscribe today.